Alright guys, welcome back for another video. Well, in today's video I want to cover exclusively price action and talk about some of the topics I didn't get a chance to discuss in the previous video. Now in the previous video I kind of touched on consolidations and how long consolidation periods tend to lead to long expansions with multiple price pauses. Basically, your bull pennant, your bear pennant, and then subsequent continuation stemming from the longer consolidation period. Now, kind of what I want to talk about here is other price distinctions. I want to talk about where price moves impulsively and marking that off on the chart. I've sort of done that here. Now you may notice that these circles are different sizes, but basically what I've done here is, marked off the areas where you start to see an impulsive price movement, right? Depending on, if you drill down on the lower time frames, you'd start to see it at different areas, but whether it's right here or right there, right here, obviously this was done on a lower time frame than when the chart was graphed, so we can mark this up here. Let's see, push this up right there, but you get the idea. And generally whenever you're price is entering a consolidation period, what you'll see is these periods of impulsive movement start to narrow, right? As price, gets closer towards, the edge of the volatility contraction, you'll generally see these points of releases form lower highs, which we actually saw here. We saw a little bit of a narrowing range, and actually it's not a great example because things are starting to break down a little bit right here. Now, the larger idea that I want to talk about is the idea of inefficient price moves and parabolas. And I think it's, good to talk about the Dixie on like the weekly chart, because there's a very clearly defined parabola right here. You marked it off right here. Again, this is the weekly chart. This is back in March 2020. And we started rallying down here in May 2021, rallied all the way up basically until, mid-October, and then started breaking the parabola in late October. But this, I think the main context I want to frame here is that, all parabolas blow off, right? If you were to draw this parabola indefinitely, it would start to curve around on itself. And eventually, there's a certain rate at which exponential growth cannot continue without, blowing off and consolidating for a little bit before the next parabolic run. But where it ties into trading is the idea that, parabolic runs have very predictable effects on market psychology. So people can't help themselves but to chase price. And they do it all the time. And, it's just one of those aspects of the market that is relatively timeless, and people are always going to chase price, basically, as long as there are markets and human psychology, hasn't evolved, right? Evolution is something that takes like thousands of years. So you don't necessarily have to worry about that changing within your career. Now, when the parabola blows off, right, we can, first off, we want to acknowledge that it happens, but we also want to trade it predictably, right? And now I'm using a very high time frame example, but this will be, extremely applicable to the lower time frames as well. You can drill down to the lower time frames and see similar parabolic moves. Now, we're probably not going to describe them as being parabolic because, if you're on a 15-minute chart, right? I mean, parabolic is an intraday move, right? That is extremely inefficient. So, I mean, for the purposes of this, we'll use the term inefficient, right? And this is something you have right here. You have this inefficiency right here. And these are areas that, we just want to draw our attention there, because what tends to happen in these areas of inefficiency is that price tends to fill them, right? It tends, people tend to chase price. Right here we have the weekly parabola being broken, kind of breaks through, comes back up and tests, and then moves inefficiently down below these lows, probably stopping people out below here. And, the market, people are generally going to chase price. And and be most bearish at the extremes. So, whenever you have a significant swing low or swing high where prices moved inefficiently, you can be fairly confident that, most people within the market are going to have sentiments that, reflect the exact opposite realities that exist in the market. But not only are they going to have, that sentiment, they're actually going to contribute money towards that belief. And kind of at least for me, what's helpful is adopting the perspective that, to be cautious, right? That if price moves inefficiently, it's likely to retrace that inefficiency on some level at the very least, right? So, chasing price is something that, we all do initially, but, not only does it not offer a good edge, but it sort of lends itself to energizing that impulsive, compulsive behavior that exists in all of us. That's directly contrary to the person that could exist with all of us, that is patient and cautious, the type of trader who is waiting in the rough for the perfect time to strike, for those high risk reward trades. Now, a parabola may be referred to as skinny leg, depending on the time frame and context. But, again, the idea is the same. And so I wanted to do that to frame kind of the context of how I'm looking at this parabola, and then run through some of the other price distinctions. One of those is the price pause. Anytime you have, and here's a good example here, anytime you have a consolidation within the context of a trend or an expansion, in this case, parabolic move up, you have these price pauses, right, where price consolidates briefly before another push, and these areas are always good take profit targets, right? Because say you're short up here, price can run down here, bounce off here, run up, and if you don't take profit, price can quickly run back towards your entry, take all your profit off the table, and even in other cases, run against you. So these are very, very solid take profit targets. Here we don't really know. I mean, of course, in hindsight, we know that the parabola broke here, but at the time, it didn't necessarily have to break here. It could have come down, hit this price pause area, and then rallied right off, right, and continued the parabola. We don't necessarily know when it will break. All we can do is just identify, when the parabola has broken. Now, that allows you to secure initial equity on your trade, and that's always going to push you into a favorable risk-reward scenario, right? If one concept I do want to illustrate here is that, if you were to take a short, again, this is very hypothetical, but just say that, you saw a break below the base here, took a short here, and then put your stop loss just above the highs right there, and we're looking for a test down into that price pause. For example, we actually have one right here before that. So a lot of times when I'll be framing an initial risk reward for a trade, I'll be kind of framing it as 1-to-1 initially, because some people arbitrarily apply risk reward parameters to their trade and say they want a 1-to-5 risk reward, or I should say, 1-to-5 risk reward. They'll arbitrarily apply that, and then it kind of, their stop loss placement is somewhere that's arbitrary because they're trying to force this risk reward parameter into their trade methodology. But one way I've found to avoid this is you just, start at 1-to-1 parity for the stop loss risk reward initially, and then once you get the opportunity to secure equity, then you can start, securing equity, and then as you secure equity by hitting that first take profit, then your risk reward profile of the trade will start to shift more favorably, and I'll show you how that works. So say we took the trade here, we saw the break below this base, and then the test up into this base right here, we took that trade, then our natural first target would be right here, because this is the first price distinction, right? This price pause right here. So, okay, so we secure equity on there. Now, as that happens, each take profit that's hit, we can move our stop loss down a little bit. So maybe it's just above the high at this point, right? And you can see, and then the next take profit would be lower. It would be at this base right here. And you can see how the risk reward profile is already starting to shift favorably. Now, this take profit may only be 20%. You know, it's hard to say exactly, but you know, personally, I use 20% limits and have 5 different take profits. But that's really a personal decision. But so say the first one was hit here, second one was hit here. Now we hit our second one, and now we can actually move the stop down below break even. Or not, excuse me, not below break even, but below these highs. And then we hit another, then price comes down, hits this area right here. Then we can move it down even further. Now, you know, maybe you move it, you know, again, we're doing this in hindsight. Maybe you end up getting stopped out, but the idea is that you can hit multiple take profits, and then, you know, maybe we end up with our stop in profit when that happens. This is just kind of showing you how that risk reward profile, you know, plays out. Now, one other thing I want to kind of talk about is that, you know, a continuation on one, you know, price distinction represents an entire price swing on another, you know, price distinction. And by that, you know, this is a good example because we have very clear continuation on this parabola, right? So, you know, let's go to a daily chart, kind of look at this as a daily, because things kind of get a little bit over the top on when you're looking at a parabolic move on the low time frames. So, okay, so yeah, so basically you have this price extension fill right here, right? This, again, we were looking at that whole swing, right? This is a whole bona fide swing on the lower time frames. Now, it does have the characteristics of a swing on the daily, so it might not be the best example. Try to find something different here. Okay, here we go. So this does not look to necessarily be a full price swing, but it is when you're looking on the daily, right? Because you break above these highs, come back and fill this. But if you were to go down to, say, a 3-hour chart, just the time frame itself doesn't really matter. But the idea is that it's just, you know, much lower than the daily size. And you can see here that this is a full bona fide swing. You've got, you know, your base down here, and then a pump up above these levels, kind of test down, doesn't hit it directly, and then pump back above, and then test back down into it, test back down, and then break above. So you have this very clearly defined continuation on a daily that just simply looks like a price extension fill. And then, but, you know, if you go down to the lower time frames, the you know, it's a much more well-defined swing within itself. Now, kind of going to the other topic is, you know, when you see a reversal, right? Kind of mentioned that every parabola blows off, right? So at some point, as the market gets more inefficient, and again, this is a great example because, right, we have the weekly parabola, but you know, this doesn't necessarily have to be a weekly parabola. It could be, you know, a low time frame parabola. But the idea is that, you know, inefficient moves tend to blow off, and they will all blow off eventually if they continue exponentially increasing their inefficiency and their parabolic advance. Those will all blow off at some point, and when they do that, they'll form an apex formation, and that's just basically a reversal formation on any given time frame. And here we can mark it by this right here. So, you know, when price is up here, we don't necessarily know that this is the apex. We only know that it's the apex when price formed this base right here, right? You've got this kind of inefficient move up, a little bit of a stutter step, price comes down, base is off there, and you've got your base forming here, now represented by this candle body right here. And then when price comes down below there, then that's kind of, you know, price starts breaking through that base, and that's when you start to look at this as an apex formation. Sorry, let me try to find this X right here. I guess we can't get the X, but the idea is that, price comes through here, you get your base break right there, and then you get a test back up into the liquidity within the apex. You don't necessarily know if it'll just test off here, if it'll run up to this area here or up to the high, but in this case, you get a little bit of a retracement prior to the break of the apex bottom, but that's where you get your confirmation, right? Before the retracement. And then this is a very good opportunity to sell after you get your confirmation down here. And so anyway, so price drops through the base, that's when we have our apex, and then we're looking for liquidity to be ran to the downside, right? So, or at least fill this gap, an inefficient price action that's been created here. So price comes down, bounces off this level, bounces up, fills this price extension right there, runs back down, hits this level right here, this price consolidation, and then rallies back all the way up, back into this base, and then starts to roll over. Now, this is, the idea, a lot of times what will happen in Apex, you don't see it here, but a lot of times what will happen is, this is just because it's coming off a parabolic advance. So it's a little bit different, but a lot of times when you're looking at an Apex, you'll come down on the base, maybe you'll come down to the middle of the consolidation and then bounce off, and then, somewhere up here, and then come back, actually test the base, bounce up somewhere down there. But the idea is that it's running above, the impulsive high right here. And then as it's running back down into the consolidation, each bounce gets lower and lower, right? Until you formally break the bottom. A lot of times that's very characteristic of what you'll see when an apex breaks. So, another way to describe it is prior to the break of the base, each test off the base generally is lesser and lesser until the break. Now, a clean breaking, once you have your break and it's clean, then a lot of times that retest will be ideal, because this is generally an area where volatility will come into the market, and you do have a favorable risk-reward profile, because if volatility expands to the downside, you stand to gain more than, if price doesn't have to go very far to invalidate your trade. So it's just a favorable risk-reward setup. And often the retests of these clean breaks are great trades. Now, a lot of times, if you want to add even more confluence, again, talking about the parabola and the inefficient price movements, oftentimes the best entries are liquidity runs coming off these inefficient impulsive price movements, basically into a pool of stop loss orders that is also confluent with some historic price level. Now, let's see if I can find something like that. We've got our historic price level marked off, right? So, you can clearly see that this is, something that is very historic, right? It represents the apex peak of a weekly parabola right up here. Again, you guys know that, but I just want to illustrate it again, just to keep things in context. So it's very historical, right? There were a ton of sell orders that hit the market here, and this area is going to represent a liquidity area, a liquidity base, right? Not necessarily stop loss orders, but a pool of sell orders that if price runs back up into there, you're going to, generally see those get filled. And that's what you see here, right? So here's a great example of a inefficient price movement up into a liquidity pool into a historic area. So we already framed the context for why this is a historic area. We see price run up in there. And now, so we've got our historic area. We've also got this high that represents a pool of stop loss orders. And we have our inefficient move up into that pool of stop loss orders prior to the break of the parabola. Again, we'll move this off because this just represents the base of the apex right here. Now, I know this doesn't look inefficient on a 4-hour, but we need to go down to, say, a 15-minute chart to see. Again, this is kind of the idea that something can look efficient on a higher time frame and be inefficient on a lower time frame. So again, we kind of framed how the historic apex and the parabola blow off, which is further on the left-hand side of the chart, is important. And then we have this intermediate high right here. So we're running up into that area of significant importance, into a pool of stop loss orders on an extremely inefficient impulsive move, at least on the time frame that we're looking at, the 15-minute. And what do you know? You know, those three things all line up, and then price, reverses pretty dramatically, right? And we actually get our formal break of the parabola right there. We could mark that off. And right, so we got those three things all lining up, and then price starts to actually break the parabola for the first time, right? The weekly parabola that's been developing for a year. So price starts breaking it. We can see that here. Price breaks through, then shoves down. You get another stop run below these levels, and then inside gap back up to this level right here, and then another stop run below these levels right here, up into this area, and then the market then really starts to hit the gas. So whenever you get a an impulsive price movement like that, we can go down to an hourly chart, kind of see it more effectively. Again, it's marked off by put circles on this area. Some people refer to this as the point of origin, but within these impulsive price movements, there will be areas where price moves less impulsively, right? You got this area here, and just kind of going over that again, you can see it's hard to explain exactly what I mean, but the idea is that you get more consolidative behavior within this inefficient move, right? This impulsive move. And that can be described as a price pause, right? It's not as defined well on an hourly, but you could go down to a 15-minute and see it better. But the idea is that those areas are generally going to serve as support or resistance. So when price comes back into that level, it serves as resistance, and you get, you can see clearly here that price comes back into that price pause consolidation area within the impulsive inefficient move and sells off. You get the same thing going on even smaller time frames, right? So you've got this one shelf here, price pause. So price is moving inefficiently, comes down here, runs back into that area, runs down, runs back into it again, runs down, before finally filling that inefficiency right here. And this is a very characteristic pattern that just tends to play out over and over. So it's one of those things where you just want to keep an eye out for it, because it will be relevant. Now, one distinction worth making is that is kind of talking about the distinctions on the price pause on first pass versus second pass. So, anytime you hit, the bottom of this is going to serve, the middle of this is going to serve, and the top, right? There's three different distinctions. But the distinction I want to point out is that when you come to the base of the price pause, the very far end of it, that will generally serve as an area of support or resistance on first pass. But on second pass, it takes an extremely different dynamic. So, at least for me personally, I would want to use this as support and resistance as price runs up into it. I may take a sell order there. If I'm long, I may take profit there. I'm generally not going to frame this as an entry for a trade, but use it as a take profit level. So if I had some context for a trade to be long down here, I would use this as a take profit. And on the flip side now, the distinction between first pass, where you use this as, you place limit sell orders there. On second pass, I'm going to use it as a area to manage risk, because if, this level has already been tapped, if price runs through there, it's probably going to fill the efficiency further. Now, this is not the best example, because there's not a huge gap between here and here. So if price does run through, it's not going to run very far in this example, because there just isn't as much inefficiency to fill here. But, a lot of times you'll see the gap will be generally much larger than it is here. So it kind of not the best example for why you want to put a stop loss there. A lot of times you'll see a much bigger gap, and the stop loss will really cover your ass in in the event where the gap is bigger and price fills it much more aggressively. And that kind of ties into, anytime you get a break of that area, that's described as a gap slip. It's basically the period, representing when price moves into the area of inefficiency, moves into it aggressively, and fills it quickly. And it represents a good area to place a stop loss order because, right, you want to protect yourself with a stop loss order in those time periods where price is moving aggressively and moving aggressively against your position. Now, here's a good example of that as well. So price, it moved impulsively down here, rallied up. You get a rally back up into that level, but once price starts breaking above, then you get a situation where, it comes down a little bit, but it ultimately fills that level. So, if you were short here and price starts breaking into this area of inefficiency, then you want to start managing risk, right? Maybe you add the position back on when it comes up here and fills this area of inefficiency and hits this point of origin. But the idea is you don't want to be sitting in a short position from down here as price runs up. Even though, generally speaking, the DXY has been in a, perennial downtrend for the last few months, still need to manage risk, right? Now, this kind of brings me into the idea of low liquidity states. So I think, the dollar currency index is currently entering a low liquidity state. And by that, I mean, it's just a period of contracting volatility, right? So you had this expressive volatility, right? Which is, you're always going to see an incredible expansion in volatility as you approach the end of a parabola, especially one that, is pretty significant on a weekly chart for a year. This is clearly a period of high volatility, especially as you get towards the crazy end of it. And even the break will also, again, you get your apex and it breaks down. That's generally a period where, volatility is going to be pretty expansive, but now we see it drying up, right? And that's pretty natural. The market is constantly moving from, periods of high volatility to periods of low volatility. So we've sort of transitioned from that high volatility period to low volatility period. And, this is sort of time bound in a sense because it can only go on for so long, right? I mean, at some point it will, keep contracting until the range narrows so aggressively that, eventually it expands one direction or the other. Now, a key distinction here is that, it will expand at some point, and the amount of time spent within the volatility contraction period or the consolidation period, volatility contraction and consolidation, are essentially the same thing. However much time it spends within those periods has a corollary effect on the amount of time that it will spend expanding. And now I don't just mean in price movement itself, but I mean in the amount of time spent expanding. So if time in the consolidation spends, is great, historically great, then you probably, when it does expand, you'll probably see multiple legs, right? So multiple bull pennants, bear pennants, price shelves, price pauses. Generally will get multiple legs of continuation. Now, we don't know how long it will consolidate for, but all we can do is identify that we are, in that period of volatility contraction. And you can, take everything off the chart. You can measure it, Now, it seems like we've kind of broken it a little bit, and maybe we have. Generally, what you would see is volatility come into the market, volume come into the market pretty aggressively during that time period. Now, we may not have broken it. I mean, you may see a further contraction of volatility as if price comes back into the range. We don't know, and we haven't had a clean break of any of the, significant highs on any level. So really, the range we're operating within is this range right here. So, we could get a bounce off there and then come back into the consolidation, and then volatility dries up. That's certainly an option. generally these volatility contractions can be represented by a pennant formation, but not always. I mean, sometimes, they really do test the whole side of the range before contracting, but then when it does contract, then, generally it will be represented by a pennant formation on the lower time frames within the larger consolidation time frame. Now, a key point to point out is that, the way, when you have this volatility contraction, the direction that price ultimately breaks really doesn't have a whole lot to do with the fundamental flows in the market. Now, if you were to get a volatility contraction on a very, very high time frame like you did here, okay, that's probably more related to the fundamental flows. But if we're talking intraday expansion, right, the direction that price expands intraday is not affected by fundamental flows in the market. So people may find that hard to believe, but again, we're talking about different time frames, right? If you're talking about the high time frames, it's going to be more relevant to the fundamental flows in the market. If you're talking about intraday, it's just not going to be affected significantly. Now, again, one exercise we can do that you saw earlier on my chart is to circle the points where price has moved impulsively. So here would be a great example, right? And then you just do that, go through the chart for all of it, and it's a very clear way to a really helpful way to analyze the structure of a chart, because you'll see these impulsive price movements tend to get filled, right? And then if you see them starting to narrow, that gives you an idea of what's going on with volatility. And also, anytime you see a expansion like this, a point of origin where price moves impulsively, you'll also have a clean break. So you'll have an area that, price comes back to and retests. Now, it's just a distinction, but oftentimes price will come back, retest off that level. I think an important point is it doesn't have to hit it directly. You can miss it by a few pips, like in this case, basically come up, and you're basically filling this inefficiency up into this area. It doesn't have to test it perfectly, and then you get a throwdown, test back up into the point of origin, and then you get a distribution pattern as it throws back down to this level. But the idea is generally the same, right? I mean, you have these consolidation periods, you have the base of the consolidation, and you generally have the break and the area where price starts to move impulsively, which on this one, we actually kind of need to go down to a 30-minute chart to see better. But yeah, you get the idea. So you have the top, the area where price starts moving impulsively, creating the break, and the break itself. And these are all very tradable distinctions. And you don't necessarily know exactly what point price will come in reverse when it gets to those levels, but you have a general understanding that price will likely refill the inefficiency and test each level and offer a reaction off each level. So the clean break is an important area to identify and distinguish. Now, some people have preferences, when they're circling this point of origin, the area where price expanded aggressively. Some people, prefer to see them towards the front of the consolidation. Some people tend to see them, towards the base. Some people tend to see them, further towards the top or the far side of the respective price pause. I generally don't really have an opinion on that. I mean, I just tend to trade them and use them as take profits and trade them where they are. But, so other people do have, more specific preferences as it relates to that. And they'll only trade them if they're, at a certain location within the consolidation. That's totally personal preference. Technical analysis is an art. It's not a science. So there really aren't any wrong and right answers. I mean, I think the best way to, address that is just say that, hey, there's no cookie cutter approach. Everybody has their own independent observations of the market. And those are often the best observations to incorporate into your methodology. Anyway, just a bit of an aside. But now one thing that's interesting is that, the point of release will often interact with, a significant weekly or monthly lower high. So let's kind of go back and get everything back on the chart that we had, with respect to the parabola. Go back to the weekly, and let's see. Well, we don't have the parabola on the chart, but we do have this area right here. So I want to mark off this weekly low. And we can, you have this expansion, and it's going to be marked, by it's always going to be marked by some daily open, right? That provides this clean break below this level. So we'll mark off this level right here. Actually, we'll mark this off. The clean break with a white horizontal line, the daily open here with a blue vertical, the weekly open here, the monthly open here, and let's see if we got a quarterly. And the quarterly. So you can see, we'll go back to the daily, or even better, we'll go back to a 4-hour, right? So you can see you have your break here. The parabola starts breaking right around here and starts rolling over, after the break, right? Comes down, bounces, rolls over, but the volatility doesn't really hit, and the gas doesn't really hit the market until this area is taken out right here. So that's our break, our level that we want to look at. And if you remember, this was a significant daily open right here. So the daily opened here, had one thrust back up into this area right here before closing significantly down. So that's an area of interest right there. Now, if we're just mapping out the point of origin, right, you've got this point of origin right here. And that's really the apex, not the apex, but really where this volatility really started, where market movers hit the gas, right? And you had your daily open into that area, and then boom, set the daily high, boom. Now we can move that off the chart. Interestingly, this was a weekly open, so we marked that off. You got your weekly open here, runs up a little bit, and then boom, your strong bodied weekly close. And then you had your monthly open here. So the monthly opened somewhere here, and then you got another thrust up higher into this area before the monthly closed, remember, dramatically lower. Now the quarterly, you got your open here, and you got your oscillation, right? But what's interesting is that the quarterly open occurred right before the the break of the parabola. So if you followed any of my videos, you know that I talk a lot about quarterly opens and quarterly closes because they are very significant. They tend to be pivot points on the market, and that's exactly what we saw here. So I don't think it's a huge surprise that you saw a quarterly open serve as a pivot on the market, in the sense that you broke your parabola right after that quarterly open, or the market shifted around, right? But anyway, we'll pull these off the chart, or we'll pull this on, and I just want to point out that this is obviously an area of extreme significance right here. Let's see, and it's lining up with those prior areas, right? And also lining up with the weekly open. So we'll mark this off here. Yeah, exactly, right there. The weekly open, go down to the 4-hour, and you can see how the weekly open basically coming in right around that point of origin. So it's just showing you confluence. Now, the ideal trade, right, when you have an area that's this significant, right, this is going to clearly be historically significant if price, say if the DXY, goes through a period of volatility contraction and breaks to the upside, fills in this inefficiency, then these are going to be significant historical levels, right, that occur on the left side of your chart. But obviously in real time, there will be other distinctions on the right side of the chart. So the best trades are ones that incorporate pretty much, your historical price levels, your intermediate time frames on the right side of your chart, and pair it up with a run of liquidity or stop loss pools. And what I mean by that is, like, what you'll again, we're kind of getting ahead of ourselves, but if you were to see this consolidation break to the upside and fill this inefficiency, you may see a test up into this level and form a low time frame high right there that isn't necessarily the absolute high, right? You may get a reaction off that level, sell off lower, and then run back above that intermediate high formed here into this historical level. So you would run into a historical level as you're taking stop loss orders that have pulled around this level right there, that intermediate high formed. And those things together, especially if it's on an impulsive price movement into that level, right, an inefficient run, parabolic run on that respective time frame, generally is going to constitute the best type of setup. Now, I know it's a little bit of a hypothetical, but I thought the DXY, considering that we just saw the break of a parabola, was a really great illustration of the different phases of the market cycle and areas of significance, particularly as you move from an extremely high volatility state to a low volatility state to a break in market structure, an expansion of volatility, and then back into a low volatility state. And I thought it was a good illustration of how the market is constantly moving between those two types of states of delivery. So anyway, I hope you guys like this video. If you guys haven't subscribed